Welcome, everybody. Good evening. It's always getting dark now as we start our calls, but we are always excited, regardless whichever call we do, whether it's our Saturday call, whether it's our Monday call, or whether it's our Thursday call. And just before we start, I'm going to bring upon our co-founder, Mahir Awad, who's going to come on board and share his experience about this whole training session that we are bringing to you. Today is the second webinar of a series of 6. There is a recording if you have missed the first one, and we really want you to learn. So Mahir is going to come on and actually talk about that right now. So Mahir Awad, co-founder of QBN and the ecosystem that includes QMINDS, MYQFX, QBN Global, Empower, and we are continually growing to make our business sustainable. So Mahir, the spotlight is yours.
Thank you so much, Shazia. Got to hand it back to you because a lot of this is possible with your hard work and your efforts. And you and I spoke earlier this morning, and I love Shazia because she works from the heart, and she does it for the benefit of the entire team, entire group, entire QBN family. So thank you for all you do. My name is Mahir Awad, for those of you that don't know me. And, I want to start off by saying, who says you can't teach an old dog new tricks, right? I did not know anything about Forex. I didn't even know what a candle was. I thought a candle was just, the lights went off, your electricity went off, you turned it on to get light in the room. But fortunately with Krish, I've been learning with him for going a little bit over 2 months now, and he's taught me so much. And he doesn't just teaches Forex; he simplifies it, and he makes it really, really, really easy. He has a gift for breaking down complexity into something that people and anyone can grasp. And this is what I truly love about him. He truly cares about every student and everybody's students group. I mean, he cares about my progress. He wants to know, and he quizzes me on past things that we've learned. So this individual, such a young man with such great talent, has taught me so much. And now I trade on my own. I know I do my technical analysis, my fundamental analysis every morning. I'm up watching the news to see what the currency does in those countries. I'm placing my own trades. And this is all in just a short period of time of less than 3 months that I've been learning one-on-one with Krish. So we're very fortunate to have him on these webinars, very fortunate to learn from his knowledge, from his growth. And we welcome QBN family really welcomes an amazing individual, our Forex instructor, the one and only Krish Nagar.
Spotlight is yours now, Krishak. You've been put under there, so we carry on from last week.
Hello, everyone. Thanks a lot, Shazia. Thanks a lot, Mr. Maher, for such a wonderful introduction. It's always been a pleasure talking with all the clients from QBN and interacting with them. This is our second session. Thank you, everybody, for making your precious time and joining the session. We are going to start off right now, and let me share my screen just a second. I'm going to present my screen, so we are good to go. All right. I hope everybody can see my screen and we are good to go. So I see a lot of new faces. I do see a lot of old faces as well who were already there in the previous session. For anybody who doesn't know me, my name is Krishak. I am a full-time day trader and an investor. Been in the markets for about 6 years now, trading FX full-time profitably. And I'm here to help you, guide you, advise you from the basics all the way to the advanced level of how to trade FX profitably. And as Mr. Maher said, the co-founder, to really simplify it and not really, make your charts look cluttered. We are all about making FX as one of the most simplified trading asset to trade. And it is also one of the most easiest trading asset to trade from my experience of 6 years. in the markets. We're going to do a quick overlook, or we're going to do a quick recap of the previous session. So before we move on to the new topic, we're going to do a little bit of a recap as to what happened in the previous session. It won't take long, and then we can move to newer topics and learn about new concepts moving forward. So the last session was all about building your foundation in FX. It was more on what is FX. So what is FX? FX is nothing but trading one currency against the other. This was FX. FX is only about currencies, which means you trade one currency with the other currency, meaning you have two currency pairs, euro against the US dollar. The first currency is always called the base currency. The reason why it is called the base currency is because the value of the base currency is much higher than the value of the second currency, called as the quote currency. In this scenario, the value of euro is much higher than the value of US dollar, meaning 1 euro equals to $1.17 per se, right? This is just an example that I'm giving you. This is what it means. I'll give you another example, USD against Japanese yen. USD now being the base currency, Japanese yen being the quote currency. How can we identify the value of this? 1 USD equals 157 Japanese yen, meaning US dollar is way, way, way stronger than Japanese yen. I hope this concept is clear for everybody because this sets the foundation for FX. And it tells you as to when you're trading a particular currency pair, what would be the exchange rate and how could you make profit when you trade a certain currency pair and not one currency. There are 6 to 7 major currencies in the world. USD, Great Britain pound, that is British pound, Japanese yen, euro, Swiss franc, Canadian dollar, New Zealand dollar, and Australian dollars. These are the major currencies in the world. And a very interesting thing about the major currencies in the world is US dollar is always against all the other currency pairs. Meaning, if USD goes up, all these currency pairs, all the currencies technically go down. If USD is going up, all the other currencies will go down. This phenomena is called inverse correlation. This is what it is called, inverse correlation or negative correlation. This is what it is called. Moving ahead, who are the participants in FX? The last session we spoke about the different participants in FX. The three main participants in FX being banks, governments, and hedge fund traders or platforms. Banks are your central banks, government banks, so on and so forth. Government is the US government, the UK government, so on and so forth. SEC is the regulation, CFTC is the regulatory body for the US, these two are the regulatory body for the US. Hedge funds are nobody, but they are called portfolio. They're somebody who manages your portfolio. And they deal with, the volume is usually over 1 billion US dollars. This is the volume in trading in FX markets, right? So these are the three three entities actually who really move the markets. And who are we in the markets? We are called as retail traders or investors. Can we really move a $7.1 trillion market? We cannot move a $7.1 trillion market. That is why retail traders are nobody but a small fish in the ocean. And all these three entities are called as the sharks or the larger fish in the ocean. So as a small fish in the markets, what do we usually do? We follow what the large fishes are doing and ride the trend, ride the wave as when they make decisions as to whether they want to strengthen the US dollar, they want to weaken euro, they want to decrease interest rates, they want to increase interest rates, so on and so forth, right? This is a general overview of who are the participants in the markets and how does the FX markets usually move. These three entities are who move the FX markets. Oh, sorry, my charts just changed. Let me go back to, okay, there we go. Moving ahead, different sessions. We looked at different sessions in FX. There are a total of 5 sessions. We have Sydney. We have Sydney, Tokyo, Frankfurt, London, and New York. These are the 5 main sessions in FX, out of which there are 3 main sessions. So the 5 sessions are diversified into 3 main sessions. Asian session consists of Sydney and Tokyo. So the pairs that you will be trading would be anything related to the Australian dollar and the Japanese yen. The next session is going to be European session, which is going to be Frankfurt and London. The pairs that you will be trading in European session would be Euro and GBP, Great Britain Pound. Last but not the least, American session. This has the highest volume. American session is called as the New York session. We only have 1 session. You trade the US dollar pairs. And American session is the most significant session. The reason why is it brings the most amount of volume in the markets. This is different sessions in FX, and this is what you trade when you look at different sessions, so on and so forth. Let's move on to pips, the final topic to recap. Pips is nothing but percentage in points. Now, this was something a bit complex, but when we look at pips is nothing but percentage in points, meaning let's look at Euro USD. Let's say if the price of Euro USD is 1.12345, if this is the price for Euro USD, how do we calculate pips? The last digit after the decimal, or 1, 2, 3, 4, 5th digit after the decimal is called as the pipette. Pipette is nothing but the smallest change in price. So as you see, let me zoom in. I know it's a bit too small for you folks. Let me zoom in so it can be a bit more clear. Okay, perfect. Pipette is nothing but the smallest change in price. Right? So as the price move ahead, pipette is the first digit. This digit is what's going to change to 6, 7, 8, 9, 10, so on and so forth. Then we have the 4th digit after the decimal. This is where the pips start. So 4 is nothing but 4 pips. So this is ones, which is 4 pips. 3 is nothing but tens, 30 pips. 2 is nothing but hundreds, which is 200 pips. 200 pips. 1 is 1,000, meaning 1,000 pips. And on the left side of the decimal is going to be 10,000 pips. So this is how we classify pips. Once we start from pipette, Number 5 is the pipette. Then we have 4, that is ones, 4 pips, tens, 30 pips, 100, 200 pips, 1, this is 1,000 pips. And then on the left side of the decimal is going to be 10,000 pips. This digit is very, very, very difficult to change. Even in a decade or maybe in 15 years, it might change, but it's very difficult to change. This number does not change easily since it is the largest number. Of course, pipette is the only digit that fluctuates the most, and it is very, very, very sensitive to the price. This is for any pair that does not consist of Japanese yen, right? So this kind of calculation in pips is only for pairs without the Japanese yen. So you could say it's for Euro USD, Pound USD, it could be for AUD USD, so on and so forth. Now let's go for pairs with Japanese yen in it. So this would be USD JPY, USD JPY, AUD JPY, Euro JPY, so on and so forth. I'll write another pair, GBP JPY as well. So we are looking at major pairs. How do you calculate such pairs this is how the pair has been calculated, 157, decimal 123. This is how this pair is usually calculated. This is how the price difference is calculated for the Japanese yen pairs. The calculation for these pairs, which does not have the Japanese yen in it versus which has the Japanese yen in it, is the same. The only difference is the placement of the decimal point. How do we calculate this? The last digit, 3, is called the pipette again. This is the pipette. The second decimal after the point is 2 pips. So this is ones. This is going to be 2 pips. The ones here is going to be 10. So this is going to be 10 pips. Seven is going to be 700 pips. 7 is going to be 700 pips. 5 is going to be 5,000 pips. And 1 is going to be 10,000 pips. This is how we calculate pips in terms of pairs that have Japanese yen in it. I hope this is clear, and I hope whatever we had looked at in the previous session, this was just a recap, and now we can move forward with the newer topics. Feel free to put down your questions in the chat box. We can take it at the end of the session, or if we can take 1 or 2 questions as we progress. If the question is related to the topic itself that we're discussing, we can take it in the middle of the session as well, not a problem. All right, today's focus is gonna be leverage. The first topic we're gonna focus on is leverage. What is leverage? This is the first topic. What is leverage? Leverage is nothing but buying power. This is leverage. Meaning, if anybody has $1,000, let's say, for example, if I have $1,000, right? I have an FX account, and let's say I have $1,000. So $1,000 is my trading capital. Now I get a leverage of 50 to 1. The broker gives me a leverage of 50 to 1, saying that for every dollar I have, I get $50 in return. So let's say if I have $1,000, which is my trading capital, how much am I going to get? I'm going to get $50,000 in return. Now, as I mentioned, what is leverage? Leverage is nothing but the buying power, meaning you can buy anything worth up to $50,000 with the leverage of 50 to 1 and with a trading capital of $1,000. This is what it means, right? So if you have $1,000, you can buy anything up to $50,000 with the $1,000. So your investment is only $1,000. Your investment is not $50,000. Do you need $50,000 in your account? No, you only need $1,000. So on and so forth, right? When we talk about such leverage, higher the leverage, bigger the risk, and greater the profit as well. There are always two sides of a coin, meaning the risk is bigger, the reward is even bigger, right? This is a good part as well as a bad part of leverage. Leverage is only used by people who are more experienced in the markets. Higher the leverage, a higher leverage is specifically used by traders who are more experienced in the markets, meaning that anybody who has less experience or under the belt I would advise not to use a full leverage. Even if you go for a higher leverage, this is more on the risk management side. Even if you use a higher leverage, 50 to 1, 100 to 1, 200 to 1, meaning your risk is going to be much, much, much higher. Your reward is going to be much, much, much higher, right? But I would advise that even if you're taking a higher leverage, even if you're opting for a higher leverage, it's always good to be under the bracket or something that a trader or a person is willing to risk. Not something that if you have $1,000, it's not that you should risk your $1,000 for one trade. No. If the trade goes against you, the whole $1,000 is gone, right? Then your account goes to zero. Then you deposit again. Markets are not going to go anywhere, right? But what we really need to manage is the risk, right? So even if you take 6 months, a year to learn, the markets will still be there. But if you look for your progress, if you use a higher leverage, coming from a perspective saying that, no, I'm going to flip $1,000 to, let's say, $5,000, $10,000, $15,000, so on and so forth. That is not how trading works. That is more on the gambling side, right? So when we get into trading, trading is a business and leverage is, of course, a part of trading. That is why higher the leverage, bigger the risk, greater the profit as well. Keep your leverage to what you can afford to lose and not something that would wipe out your whole account. Even if you start with as little as $500, $1,000, keep your leverage bare minimum so you know that you have a buying power, but you're not misusing it. That is the important point, that you're not misusing it and you're not over leveraging it. The reason why a lot of traders lose is because of over leveraging. This is the main cause of a lot of people losing money is because of over leveraging. They're expecting to make $1,000. Sorry, they're expecting to make $10,000 from $1,000, right? Which is more than, which is actually 1,000% gain based on your profit, right? Based on your capital. So over leveraging is something that I do not suggest for anybody. Always be within your risk limit. And this is how, and trading is going to be much, much, much easier for you because your losses are going to be small, your your rewards are going to be way bigger than your losses. Let's move ahead. Now, if you have a leverage, let's say trading capital is $1,000, leverage is 50 to 1, maximum risk. So total buying power is going to be $50,000. This is the total buying power. What would be the maximum risk? Can anybody write down in the chat box? If you have a leverage of 50 to 1, your trading capital is $1,000, which means you have a total buying power of $50,000. What would be the maximum risk? Profit is going to be unlimited. Yes, we don't have any cap for the profit, but what would be the maximum loss a trader can lose? And yeah, what would be the maximum risk? Anybody can write down
I can
in the
see
chat box.
I can see 10%. Someone's put in the chat 10% max.
10% now. Shadi, I think I'm not able to see the chat for some reason. I
You
cannot see
should
the
be able
chat.
to. If you click the chat icon at the bottom, it should open up a pop-up underneath, and then you should see there it comes up in that little box there.
I have the chat box open, but I cannot because my chat is for everyone. So I've clicked on everyone,
Yes, if you
and
take
there's
it through,
private message. Yeah,
let me just see if I can adjust.
yeah, because I cannot see any messages, but it's okay. Nonetheless, so somebody said 10%. Okay, no, that's 10% would be a stop loss, not your maximum risk. 10% would be a stop loss.
Right, can someone put something in the chat so we can just test that Krishat can see? Let me put something in.
Sure.
Can you see that? Someone's put 1,000 in now, just to test
I
it.
see. Yes, I see Samuel put 1,000. Usman
Yeah.
Ahmed said all of it basically.
Yeah, so you
Yes.
can see it now, so it's coming through. Okay, brilliant.
All right, perfect. 50%, 10% loss. The maximum loss is gonna be $1,000, which is your trading capital. This is gonna be our maximum loss. A maximum risk, a maximum loss is gonna be if somebody forgets to put a stop loss. If let's say, for example, if I place a trade and if I forget to put a stop loss and the market goes against my direction, the maximum money I'm going to lose with leverage is only going to be $1,000 and not $50,000. Does that mean that you have to pay to the broker? Now, who gives the leverage? Who actually gives the leverage? Leverage is given by the broker itself. The broker gives the leverage, right? So the maximum risk or the maximum loss without putting a stop loss a trader can lose is their trading capital and not the amount of leverage. A lot of people mistake, they think that total, if they have a $50,000, they will lose $50,000. In that case, they have to pay $49,000 back to the broker. No, as the trade goes against your direction, the broker will automatically cut down your trade at $1,000 at -$1,000, which means you don't have to pay anything back to the broker. That is the best part of leverage, right? Which means you don't owe anything back to the broker. So leverage is given by a broker. So when you place a trade, depending on your quantity, when you place a trade, the margin directly comes into your account, right? Now, there are a few things that we need to be aware about is when you place a trade, there are going to be multiple factors. One is margin available. Margin available is nothing but your trading capital that you have deposited, right? This is margin available. And then the next option is going to be estimated buy margin slash estimated buy margin slash estimated sell margin. This is the amount required to place a trade. This is what it means. Estimated buy margin slash estimated sell margin is the amount required to place a trade with leverage. Right? With leverage. I'll be showing you a live example as well. As we move ahead, I'll be going back and showing you the live example. How to place a trade. We'll also go over that as well after we are done with the leverage topic. So these are the two things that every trader should know and they should not be confused. Margin available is going to be your trading capital and not amount with leverage. No, this is your trading capital. This is the money that you have deposited into your trading account. I hope this is clear because I don't see any questions in the chat box. Shazia, please let me know if there are any questions, but as of now, I don't see any questions in the chat box. All right, thank you. All right, let's move ahead. Let's say I wanna place a buy. Let's go and connect my paper trading account. I'm gonna go connect my paper trading account and we're gonna place a buy order with leverage. I'm gonna place a buy order. Let's say, I hope everybody can see this little screen here. Let me go to a Forex pair, Euro USD, paper trading account. All right, there we go. Let's say I want to buy euro against the US dollar. What I do is on the top left corner, I have two buttons. One is for the sell, which is short selling, and the other one is to buy the asset. When we click on buy, a box like this will pop up. Let me zoom into the box. Just a second. Okay. A box like this is gonna pop, right? Units is nothing but your quantity. Units is nothing but your lot size. We'll also be looking at that after we are done analyzing the whole box. Let's say I want to place 1,000 units. I want to place 1,000 units. This is take profit. This is where I want to take my profit. Let's say if the market goes in my favor, this is where I want to take my profit. So I can place a take profit in terms of price or in terms of reward as well, either ways. Next is going to be stop loss. Stop loss is the total risk that I'm okay to lose, right? This is a stop loss, meaning if the market goes in my direction, I can put the risk as, let's say I'm okay to lose, let's say $100. If I put risk as $100, the price automatically pops up and my reward is going to be $200. Risk to reward 2 to 1. Coming down to this box, order info box, leverage. My leverage is 50 to 1, meaning for every dollar, I have $50. This is my margin, 53,294. This is not real account. This is a demo account. Pip value. Pip value is for every pip it moves, I'm gonna gain 10 cents. This is what pip value means. So it will also give you a pip value, meaning for every pip it moves, with 1,000 units, you will be gaining 10 cents for every pip movement going up in your direction or going against your trade is going to be plus minus 10 pips. Trade value is the total value of the asset for $1,000. So the trade value is going to be, I'm going to write it down here so everybody can take notes as well. Pip value is nothing but the amount a trader gains or loses as it goes, as the price moves. So for every pip, you gain 10 cents. This is pip value. The next is trade value. Trade value is the total value of the asset without the leverage. This is trade value. The total value of the asset without the leverage. The risk and reward is, risk is nothing but stop loss in amount, and reward is profit target in amount. A minimum risk to reward ratio, a minimum risk to reward ratio should be 2 to 1 or 1 to 2 or 2 to 1, either ways. It's more or less the same. Let's keep it 1 to 2. Meaning for every $10, your reward should be double your risk, $20. This is how you can be profitable in the markets because you're risking less to gain more. But if you risk more to gain less, even if you win, let's say 7 trades out of 10, you're still going to lose money because you have to take in account for brokerage. You also have to, and your risk is going to be much bigger. So your losses are going to be much bigger than your profits, technically depleting your account very fast, right? So that is not a profitable way to trade. This is a profitable way to trade wherein you risk $10 and your reward is going to be $20. It could be $10 you risk, $100 you risk $10,000, but make sure your reward is always bigger than your risk. It could be $20, it could be $15. $20 is ideal, double the risk. Reward is always double the risk because even if you lose five, you win five trades. Winning percentage is 50%, including the brokerage, you're still able to make money. You're still being a profitable trader, right? Even with a 50% or even with a 40% winning trade, you will still be able to make money. Whereas you lose six trades, you gain four trades, you're still making money. But if you keep your risk as 10 and your reward as 10 as well, your risk 10, reward 10, win and loss percentage is 50-50, including the brokerage, your account will be sitting in negative because you're not losing anything, you're not gaining anything. In fact, the brokerage is adding up, right? And brokerage is something that we cannot avoid. And so we also have to take in account for brokerage fee, commission fee, whatever we call it. And that is why the minimum risk to reward percentage or ratio that I suggest should be 1 to 2 or 2 to 1. I hope that's clear. I hope this box is also clear. Coming back to this box, we have covered the majority of the thing. There is a margin requirement here which says 2322. What is this margin requirement? Margin. I have 53,294 in my trading account. This is my trading balance. Margin that you see here, this amount that you see here, 2322, is the margin that you need to cash out. This is actually estimated by margin, right? So this number right here, let me bring my box so I can point it out. Estimated by margin is 22, 23, 22 US dollars. This is what this number means. And margin available is your trading capital, which is 53,294 USD. Meaning out of 53,294, you're only going to cash out or you're only going to invest $23.22 to place 1,000 units worth the trade value, which is $1,160.82. This is what it means. You don't need to cash out $1,000. With leverage, you only need to cash out $23.22. I hope this is clear. If any doubts, you can please let me know, put down in the chat box, and I can repeat it again. All right, I don't see any chat. All right, we can move ahead. How do you calculate the margin estimated by margin? A lot of people might get confused that if you have a leverage, how to calculate the estimate by margin. There's a very simple way, how to calculate the buy or sell margin. There's a formula to it. We don't really need to calculate it, but it is always good to know in case if a platform or any of a trading terminal does not offer. It's always good to know as to how do you calculate the buy and sell margin is trade value divide by the leverage. So in this case, if the trade value is 1,160.90 USD, you divide it by leverage, you get a buy margin of $23.22. So to place a trade worth $1,000, you only need to cash out $23.22 with leverage of 50. In case if the leverage is less than 50. In case if you have a leverage of less than 50, you will have to cash out more. Let's say you have a leverage of 20. So what you do is 1160.92 divide by 20. The estimated buy margin is going to be 58 $58.46. This is going to be the estimate buy margin. Lower the leverage, bigger the margin requirements increase. Higher the leverage, the margin requirements decrease. I'll give you another example. If the leverage goes to 100, the buy margin is going to be just about $11 to place the same trade value. But the reason why the buy margin is low is because of higher leverage. So the buy margin entirely depends on buy and sell margin, not just the buy margin. The buy and the sell margin entirely depends on how much leverage you're opting with the broker. I hope that's clear. Any more doubts? All right, we can move ahead. So this is how we place buy order. Then we click on buy, the order is already placed. We can put a stop loss, take profit, so on and so forth. As we increase the units up top, you can see where my cursor is up top in the unit box. As we increase the units, the margin requirements increase. The leverage stays the same. Trade value increases, risk increases, reward increases, so on and so forth, right? If I place a trade worth 10,000 units, my trade value goes to 11,600, and my my estimate buy margin goes from $23 to $232 because I increased my unit, I increased my quantity. I hope leverage is clear. Let's move on to a newer topic. I hope we have time, Shazia. Is it possible to take another topic if that's okay?
Yeah, we have it 6:46. If anyone's got questions, if you start popping them in the chat, then at least we can factor in the question and answer time. Isn't that correct, Krishak?
Yes, of course. Yeah.
Because otherwise, the
Yes.
session's till 7 o'clock. But if anybody has any questions, start populating them into the chat because we don't want to stop and then there's no question answers as well. So just to get the balance right. Thank you. There's no questions as far as I can see, Krishak, so I guess you can carry on with the next topic.
All right, sounds good. So let's look at the final topic for the day. This is lot size. Lot size is very, very, very important topic. And it's like when you buy shares of a company, you buy one share, you buy 10 shares, you buy 5 shares, 100 shares, so on and so forth. That is quantity. But in FX, we have something called as lot size or units. To calculate, it's a very different way to calculate it, actually. There are 3 kinds of lot size. We're going to go over the 3 kinds of lot size. It starts with micro. We have mini lot size, and then we have a standard lot size. Micro, mini, and standard. What it means? What does micro, mini, and standard means? Micro lots are going to be your bare minimum lot size, nothing but it's your entry barrier. This is the lot size where you need to place to enter the markets. So it starts with 0.01 lots to 0.09 lots, right? Meaning lots 0.01 is nothing but 1 cent. It is 1 cent in terms of dollar amount. But when we calculate lots, we just say 0.01. We don't calculate in terms of dollar amount. When we convert it into units, that is when we calculate it in dollar amount. So 0.01 lots equals to 1,000 units to 9,000 units for 0.09 lots. What are units? Units is nothing but it equals to the dollar amount. This is units. So don't confuse units with something else. Units equals to the dollar amount, meaning if you're placing a trade of 1,000 units, you're going to place a trade worth $1,000. This is what it means. This is what it means. If you're using 0.05 lots, If you're using 0.05 lots, you're placing a trade of 5,000 units equals 5,000 US dollars. Do you need 5,000 US dollars? No. With leverage, no. Without leverage, yes. Right? Without leverage, you need this amount. With leverage, you don't need the amount. With leverage, as we saw the box, the little pop-up box, the trading window, a new order box, you only need $23 depending on the leverage. Lower the leverage, larger or higher the estimated buy and sell margin. Higher the leverage, lower or lesser the estimated buy or sell margin. So this is micro. Micro lots is for somebody who are for beginners who are just beginning in the markets, who wants to experiment and who has a trading capital of less than, let's say, $1,000. This is for somebody who wants to experience in the markets, right? Somebody who wants to see how it works, how lot size placement works, how much are they gain, how much are they going to make, how much are they risking, so on and so forth. Next lot size is mini. Mini starts from, as micro ends at 0.09, mini is going to start from 0.1 lots to 0.99 lots, 99 lots. If we calculate this in terms of units, it's going to be 10,000 units to 99,000 units. This is what it means. Meaning, if we calculate again in terms of dollar amount, 10,000 units equals nothing but $10,000 to 99,000 US dollars. This is because the reason why we are doing this is units equals to the dollar amount. It's like this. I'll pop up the box again. If I place 10,000 units, I have currently placed 10,000 units. My trade value is going to be $11,600 depending on because the price is 1.160 into whatever the units is. This is what I'm going to get, right? This is going to be my trade value. Just to buy any asset worth $11,600, I only need to cash out $232 estimate buy margin. The reason why is because of leverage. My leverage is 50 to 1. With 50 to 1 leverage, I only need to cash out $282 to place an order worth $11,600. I hope that's clear. I'll X out of the box. Micro, mini, and the last one is going to be standard. Standard lots. This is where the real deal is. This is where the real money is made. 1 to 999.00 lots. 1 lot to 999. 1 lot equals 100,000 units. To how much? Okay, let's do an exercise. 1 lot equals 100,000 units. 10 lots. 10 lots is 1 million units because 10 times of 1 lot. So 10 times of 100,000 is going to be 1 million. 50 lots is going to be 5 million units. 100 lots is going to be 10 million units. How much is 500 lots going to be? How much is going to 999 lots going to be? 500 lots is going to be 50 million. 999 lots is going to be 99.9 million units. Now, are we allowed to place trades anything worth 99.9 million units? We are capped to placing trades up to 500 lots. This is the upside of placing lots. We are capped to placing 500 lots in FX. 999 is just for information. Yes, you can go up to 999. Some brokers allow, some brokers do not allow. And it's a good thing as well for risk management that if somebody has a larger account and they take the highest leverage, just so that they do not lose all the money, they would like to cap down the risk, cap down the lot size. They want to keep a cap at the lot size at 500 lots only, which is 50 million units, $50 million. And that is why I'm going to say it's from 100,000 to 50 million and not 99.9. This is a very important topic. This is something that we will be using it over and over again in trading when we place orders live in the markets by clicking the boxes up above, buy and sell. Units is the first box that you see. This is how you change the units. 100,000. So you start from 1,000. You put another zero, 10,000. You put another zero, 100,000. You put another zero, 1 million, 10 million, so on and so forth. Right? I'm gonna zoom out a little bit. So if anybody wants to take a screenshot, they can for the lot size. Let me rearrange it. Just give me a moment, please. Yep, feel free to take screenshots. There are 3 different lot size, micro, mini, standard lots. This is the classification of lot size or units. This was the final topic. I think we just have about 4 to 5 minutes for the session to end, so it won't be possible to go for a new topic. We can go ahead and take, if anybody has any questions related to the previous session, as well as for this session.
Any questions? Please feel free. I've also allowed you to unmute yourself. So if you're not a person who likes to ask a question in the chat box, you can ask the question live, verbally. Just to tell everybody that previous recordings currently are on one channel, but they will be shared on the MyQFX channel as well. So we're going to paste them out as far and wide as we can. So we've had one session that has been recorded and translated. This is a second session translated into Spanish. Let me just be clear. This is a second session. It will also be translated. It's going on to one of the QMINDS channels. It will also go on the MyQFX in the next few days as well. And all of this information will be shared on social media. And what I'm doing is collecting everybody's email addresses. And I hope you did get an email today. I was testing out just to see that we can send reminders as well. So we are trying our best to share as much as we can. I can see some comments. Krishak, I can see someone saying a great session. For beginners, it's better to stay within the micro lots for now than move up from there. I don't know if that's a question or a comment. Samuel, the schedule is there. This is session 2. We will continue 6 sessions and then we will start again. So they will progressively work. ZA says it's a great session as well.
I have a comment, Shazia.
Sure.
And when I was studying this particular subject, I already know the answer, but maybe you can explain. Down at the bottom, Krishak, you put units equal dollar amount. People might get confused where it says 1,000 units. They're thinking that might be worth $1,000. Do you understand what I'm saying?
Mm-hmm.
At the very beginning of, if you're a new beginner, that can be a little confusing to people. So under micro lot, you put 0.01 lots to 0.09 lots, and then you put 1,000 units to 9,000 units. Down further, you put units equal to $1. So when people see this, they're thinking $1,000 to $9,000 on a micro lot. Can you explain that for people that are beginners?
Sure. Units equals to the dollar amount, meaning that if you place a trade, let's say for $1,000, 1,000 units, it is gonna be $1,000. But do you need to cash out $1,000? No, you don't need to cash out $1,000. $1,000 is just going to be the trade value. the value of the trade depending on the price of the asset, right? So if we take Euro USD, the trade value, it says for Euro USD, if I change it to $1,000, the trade value, let me zoom in again. The trade value that it says is $1,161 because the price is 1.16120, right? That is why it says the trade value as $1,000. So if I put the unit as 1,000 units, it equals to the trade value of $1,000. If I change the unit to 10,000, it's going to change to $11,000. 10,000 units equals to $11,000. Why? Because the price is 1.16120.
Thank you.
Is that clear, sir?
Yes.
Thank you.
I have a question from somebody about the advanced sessions. So I don't know how we want to answer that, because I know that we have these foundational sessions to understand how to trade, but then Krishak, you also have more one-to-one sessions for people who want to go deeper. But we also have a session on Monday as well with another educationist too. So if you need more information, feel free to email us, and we can send out a more detailed schedule as to what you can attain where. I'll put the email into the chat.
Osman has commented, for beginners, it's better to stay away. It's better to stay within the micro lots for now, then move up from there. That is correct, Osman. As a beginner trader, it's always to use micro lots and mini lots as well, and not to go with standard, because with standard lots, as you increase the lot size, your risk increases, your reward increases as well. And standard lot sizes for somebody who is much more experienced in the markets. I myself started with micro lots. I started with 0.01 lots, and then that's how I started to increase my lot size from mini to standard and so on and so forth. So that's a beautiful comment. Thank you very much.
And just Samuel, I'm just putting the link to the YouTube channel where they're going to be uploaded into the chat. Can you please take note of that? And subsequent sessions will also get uploaded there as well. When I emailed the email list today, the link went to that list too. So if you are in the registration, you will get an email next week. They will also be linked into that as well. So thank you. It's pleasing to know that everybody wants to get hold of the recordings. And that, I think, brings us to 7 o'clock, Krishak.
Well, yeah, I don't see any more questions, but we can give it a minute. Thanks a lot, Osman, for the beautiful comment. We can give it a minute if there's any other questions. If not, then looking forward to seeing everybody again next week. Thank you, Shazia. Thank you everyone for joining in.
Thank you, Krishak, for your time and your knowledge. Again, if you have any questions or comments, you can email hello@myqminds.com. We will also be putting content out onto social media as a reminder. On top of that, the YouTube channel will be constantly published too. So I have shared it in the chat a couple of times. It's also added to qbnecosystem.com. So just so you're aware, www.qbnecosystem. I'm putting it into the chat, qbnecosystem. Better get the spelling right, so that you can access it. So it shows all of our products, and you can access the YouTube channel from there as well. So once again, thank you everybody for joining. I hope you had phenomenal learning from today. I've again made lots of notes. And thank you, Krishak, for leading the session. And we look forward to seeing you all again next week, same time, same place.
Thanks a
Mahir,
lot, everybody.
a closing remark, or shall we close?
Well, now that you called my name, I can't not close. You know, it's amazing. Krishak, again, you've done such a phenomenal job. So for everyone on this call, make it a point to invite at least one person. If everyone on this call invited one person, we'd have 50 people next week. Is it that hard to invite just one person? No. Okay, so make it a goal to invite one person to this call. It doesn't matter if they're, if they don't know Forex, they do know Forex, they want to learn more about Forex. If they're a seasoned Forex, because we got the best of the best here teaching us. And So let's continue growing this channel, this webinar to more people, so everybody can learn, everybody can benefit from. And remember, on our QBN Global platform, we have demo accounts. So if you have some basic knowledge and you want to open a demo account, it's not your own money, it's just play money like Monopoly, and you could start practicing, you know. And then this would be a great way for you guys to ask your questions. Don't wait till this session to ask your questions. Write your questions down on your phone, on your book, on your tablet, so you can have those questions for whenever we have these sessions. So again, thank you everybody for being on the call. Love you all, and look forward to seeing you guys soon.
Thank you very
Thanks
much,
a lot.
Wahid. Thank you very much, Krishak, as well. And thank you each and everyone that joined, because this would not be successful without you all. So it's good night from us, good afternoon wherever you are, or good morning. Take care. Bye-bye.